Forex trading is how individuals, banks and businesses convert one currency into another. Trillions of dollars worth of Forex transactions take place every day, making it the largest financial market in the world. Unlike stocks or commodities, there's no central exchange for trading Forex. Instead, currencies are traded via a global network of banks, dealers and brokers, means that retail traders can trade Forex day or night, Monday to Friday. So how does it work? Well, Forex prices are quoted in pairs, because in effect you are simultaneously selling one currency while buying another. Let's take euro-dollar as an example. On the left is the euro, known as the base currency, on the right the dollar, or the quote. If the price of euro-dollar is 1.38, that means 1 euro is worth $1.38. When trading Forex, you're always quoted two prices, the buy and the sell. The difference between the two is called the spread. You'd buy this pair if you thought that the base currency will strengthen against the quote currency, known as going long. Alternatively, you'd sell if you thought that the base currency will weaken against the quote, known as going short. Forex prices are influenced by a range of different factors. These include interest rates, inflation, government policy, employment figures, and demand for imports and exports. And because of the sheer volume of traders and the amount of money exchanged, price movements can happen very quickly, which makes Forex not just the largest market in the world, but also one of the most volatile. To start trading, open an IG account today.